Hello, everyone. I, on behalf of Women and Young Members Excellence Committee of ICI, welcome you all in the Sky High Symposium Series 63. Sky High Symposium is a Wednesday series of programs conducted by the Committee for the Women and Young Members. It's one of the Women and Young Members Excellence Committee initiative to not only disseminate the information to members on technical updation and non-technical skills, but also to empower and inspire them to come at forefront and realize their verbal skills at public forum. Today, we are going to cover the session on SA 315, that is risk on material misstatement, and SA 330, that is the auditor's responses to assessed risk. For the said session, we have a very talented, eminent speaker with us, Mrs. Alpa Kedia. I take this opportunity to welcome her for today's session. Mrs. Alpa Kedia is a fellow member of ICAI with 26 years of professional experience in providing services to several domestic and multinational clients, including retail and consumer sector, industrial production, chemicals, NBFCs, broker-dealers, mutual funds, and insurance. Her expertise has been accumulated through extensive experience in managing teams, undertaking audits of various listed and private sector entities, and other special projects. Her area of work includes statutory, tax, management, and internal audit. With this brief introduction, I, on behalf of entire committee, welcome you for today's session.
Thank you. Thank you so much, Amit. Really appreciate it. Thank you. Good afternoon. Not sure how many participants we have. Ami, Vinu, would we have a count of how many participants have already joined? Okay, I guess we don't. So without, okay, thank you. Thank you so much. So maybe I'll quickly set the context of the reason why we are spending our evening talking about SA 315 and SA 330. As you know, the Indian economy has been growing, and with that, clearly our corporate India has been growing both in the listed sectors and the private spaces, right? With the increasing size, scale, and complexity of business, it's very important that the function that we perform as chartered accountants, which is auditing the financial statements of these companies, we do that with the degree of rigor that it enhances trust in these financial statements so that various stakeholders are able to place reliance on them. Given the increasing size, scale, and complexity, of course, as auditors, it would be very difficult for us to be kind of doing 100% audit of all the transactions that a company would enter into. And hence, as an auditor, it becomes very important for us to identify the areas on which we should be spending maximum effort in terms of doing the audit and designing our audit procedures appropriately. It is in this context that SA 315 and 330 become extremely important, because the objective of the standard, and at this point I'm going to restrict myself to SA 315. My colleague will separately talk about SA 330. The objective of the SA 315 standard was to really provide a thorough understanding of the entity and the environment in which the entity operates, both internal and external, with a particular focus on the entity's internal controls. Yeah, because we all agree that it's very difficult to do an audit of a company where we don't have an understanding of what the entity is all about, what is the entity's business, what are the entity's challenges, and how does it operate. So in order to ensure that we all do this consistently, SA 315 provides us with guidance as to how we could, as part of the audit process, carry out an understanding of the entity and its environment with the objective of identifying or assessing the risk of material mistake. Yeah, this auditing standard was applicable for financial statements for periods commencing on or after April 1, 2008. Uh, and while there is an exposure draft, it's not yet been notified. So this is the current standard that we all apply. So let's talk about, how do you kind of go about understanding the entity and its environment? One of the important factors in developing our understanding is carrying out risk assessment procedures, right? Uh, how do you kind of do the risk assessment procedures? Uh, Again, these are done at several levels. The levels at which one does this is, of course, at an industry level, at an entity level, at a sorry, just 1 minute. I'm just trying to kind of see the slide. Yeah, okay, sorry. So it's at different levels that one does the risk assessment. One does this at an industry level. You need to have an understanding of which industry you're operating in. So inherently, some industries tend to have a higher degree of risk. For example, the financial services industry. You then also do a risk assessment at the company level. So within the industry, how does that company operate, right? You then, of course, also get down to doing a risk assessment at the financial statement level and transaction level. How does one do the risk assessment? Uh, there are various procedures that could help us as auditors to perform the risk assessment. First and foremost being the inquiries with management. Uh, Again, when we talk about inquiries with management, historically and traditionally, our inquiries used to be restricted to typically the finance personnel. In today's era of different functions having oversight of different KPIs, the inquiries of the management tend to be need to be more broad based, more widened. So you should be making inquiries across functions. For example, inquiries can be made with sales and marketing personnel. Inquiries would need to get made with legal counsels. Inquiries would need to get made with risk management. Inquiries would need to get with human resources. Inquiries would need to get made with internal auditor. And of course, we also need to make inquiries with the finance personnel. When we are doing these inquiries, the other factor to keep in mind is whether who are the people with whom we are making inquiries. So definitely the heads of the departments or the C-suite, as we call them, inquiries with them become extremely important. But often results show that inquiries made across functions, across different levels of authority, tend to yield much wider results. So at times it is more fruitful to make inquiries of a person who is actually processing complex transactions in addition to making inquiries of the head of the department. Inquiries can of course also be made with those charged with governance. So one starts with making inquiries with the board, the audit committee, and then of course the management. Inquiries can be internal or external. So for example, if you have an internal auditor who is an external firm, making inquiries with them, or if you have a legal counsel who's external to the organization, an independent legal counsel, inquiries with them would also be useful. The inquiries, of course, need not necessarily be restricted only to finance. So if you're talking to a sales and marketing personnel, inquiring with them about different products, uh, different maybe marketing schemes, etc., would give you great insights into what one could expect when one is looking at financial statements. So, for instance, if the head of marketing says, and if we are talking about an auto menu, about a car company, if he says a model number so and so has been discontinued and has been taken off the market, it gives you an indication that when you're looking at the financial statements, the sales for that particular model number may either have stopped at a point in time, or there may be more marketing and discount schemes that may have been offered by the company in order to move the inventory that is remaining for that particular model. Or it could give you an indication to say that there is some impairment trigger for assets that are used in the manufacture of that model. So inquiries with functions other than finance would help you to link back to building an expectation of what you should probably expect to see in the financial statements, and to assess the risk that exists in the financial statements. Uh, we have a practical example a few slides down, and we will go to that and look at some of the examples that I have spoken about, but maybe just at a conceptual level. So how does one do risk assessment procedures? It's like I said, inquiry with the management, and I kind of use a much wider definition of management over here, which included internal audit, which included legal counsel, which included also making inquiries of the board and those charged with governance. One also carries out analytical procedures. So what is typically analytical procedures, right? It is comparison of financial data between two periods. It could be between 2 quarters, it could be between 2 year ends, it could be comparison of data between actual for the previous period versus actual for the current period. It could be comparison of data between budgets and actuals. Uh, Essentially, doing this sort of an analytical procedure gives one an indication of any unusual trends or relationships that one is seeing between various account balances, which will again help the auditor to focus his or her audit procedures specific to those areas. The other last method for also doing risk assessment procedures is observation and inspection. Uh, Classic example over here would be when we carry out when we send our teams to carry out inventory verification, and our teams make those necessary inquiries and observations and inspection during the course of those inventory verification. So if you see a huge amount of inventory of a particular type piled up and you make inquiries of the management at that point in time as a result of the inspection that you've carried out, that could again be an indication of a specific risk that exists, which may need to get addressed as part of the audit. Uh, in addition to the risk assessment procedures, as I explained, one also considers information that is available to us as part of our acceptance or continuance process. All of us typically evaluate various data points when we kind of accept a client or when we decide on continuing with the client. So for instance, we do kind of look up what is available in the public domain, maybe in the investor decks, or maybe in various public domain information, such as um, you know what's been put out by the company on its website, or competitor analysis, or trade magazines, etc., which give us an indication of the client's standing in the market and the company's, if I may use the word, sort of a public janam kundli, right, as to what is good and what is bad about the client and the promoters, etc. Right, so that is information that we all tend to gather prior to accepting the client or continuing with the client. And so it's useful that we apply that information as part of our risk assessment procedures. Often we come across situations where, whilst we may be considering an audit engagement, we may have engaged with the company on other matters. So maybe some advisory engagement that we may have done for the client, or maybe in the past we were internal auditors. It's very important that as audit teams and as auditors, we keep in mind information that we were privy to as a result of those other engagements, and learn to join the dots in terms of how this is going to impact our our audits, and what could be risks that could emanate as a result of joining the dots that maybe we may not have been aware of. Yeah. Um, Last but not the least, one of the requirements of the auditing standard is that as engagement partner and key team members, we need to all have a very robust discussion around understanding the entity, its environment, and identifying those risks. And we should ensure that we carry this out at various levels, like I said, entity level, and then at a financial statement level and an assertion level, to ensure that we identify which of those account balances could be most susceptible to the risk of material misstatement. So we spoke about gathering information on the entity and its environment. And again, when we're talking about gathering information on the entity and its environment, we could do this through multiple sources. Everything that we discussed from a risk assessment procedure was far more internal to the client. One could also use external sources to kind of gather information about the client. Let's start with the environment. So what are the factors in which one would typically look to kind of understand the environment in which the company is operating, right? So like I said, what's the relevant industry? Is the industry an industry in which there are few players? Is it an industry in which the competition is very high? What sort of factors are there in terms of demand and supply? How does price discovery happen? Is it a cyclical industry? Is it an industry which depends a lot on technology? So for instance, the new age companies like the fintech companies, right? How does the supply and cost factors affect the industry? Are there macroeconomic factors that are in play right now, which is likely to impact the industry and hence the company that we are talking about adversely? So, for instance, the Russia-Ukraine war saw a big energy crisis and saw logistic crisis for movement of goods from Europe to various other countries. That could be one macroeconomic factor that one would need to consider in developing the understanding of the present environment in which the company is operating. Like I said, the process of understanding the environment and the company is a continuous and a dynamic process. One continues to gather, update, and analyze information. So, for instance, the Russia-Ukraine factor has been a factor that was prevalent in the last 2 years. If you had done an understanding of the environment prior to that and did not update this for recent developments, you would have missed out on something which was very critical to the company if the company was usually dependent on supply sources emanating out of Europe. Uh, Again, the level at which one wants to kind of develop an understanding of the environment and the entity is really a matter of judgment. But as a general thumb rule, the depth of the overall understanding that an auditor will have will be generally lower than what would be possessed by the management of the entity. Understanding the entity and the environment helps the auditor in a number of factors. So, for example, um, once you understand the industry in which it is operating, there are specific regulatory frameworks to which a particular industry could be subjected to. So, for example, if you are in the auto manufacturing industry, and the regulatory norms around carbon emissions, BS6 norms, etc., could have a major impact on that relevant industry or the client. And therefore, understanding the external regulatory environment is likely to again identify or trigger a risk that you as an auditor need to be aware of. Uh, Taxation could be another area. As we are aware, um, in the last 3 or 4 years, the Indian tax regime has seen a significant change with the reduction in the number of exemptions and deductions that were available to a large number of corporates and the reduction in the tax rate. So, understanding the tax regime in which your company or your industry is operating in is extremely important. Government policies affecting the conduct of the business. So again, using the auto manufacturing company as an example, the government policies right now are very conducive to the EV vehicles and EV auto manufacturers. So having an understanding of the regulatory environment for that particular industry and hence how it applies to the company that is being audited would become extremely important in identifying the risk of material misstatement. There would again be other factors, so very general factors such as interest rates. We are living in a era of rising interest rates for the moment, and high inflation. If it is an export oriented industry, the currency movement at the present moment could again result in a risk of material misstatement if it is not managed and accounted for properly. So that was on the environment. If we then talk about the entity, uh, coming from the external environment into the entity, important to understand the operations of the entity. What do we mean by understanding the operations of the entity? It's really understanding what business the company is in, how does it operate its business, nature of revenue sources, what are the markets in which the company operates in, what are the alliances or joint ventures that the company has. Typically, factors like where are the production facilities and the warehouses located, who are the key customers, is it an export oriented unit, who are the important suppliers. So, understanding the operations of the entity, understanding the ownership and governance structure. So, how widely held is the capital of the company? Is it a promoter driven organization? What is the governance structure and the tone at the top? So, does it have a well defined board of directors? What is the composition of the board of directors? Are there independent directors who are on the board directing the affairs of the company? And developing an understanding of that will again help you identify if the tone at the top is appropriate and whether there could be any risk of material misstatement which may trigger as a result of this. Right? The other bit around understanding the entity is understanding the appropriateness of the accounting policies that are being used by the entity. So whether the company tends to be conservative in making a choice on the various accounting policies that are available, or does it tend to be more innovative in terms of the accounting policies that are being applied? And how often does the company change the accounting policies, or is it consistent in its application of the accounting policies? The other factor that one must consider in understanding the entity is, of course, what are the objectives and strategy that the entity applies, right? So is the entity focused only on profit, or is it an entity that is focused on ensuring that while profit is an important parameter, how does it add value to various stakeholders? So what is it that drives the entity in terms of its strategies, and hence the related business risk emanating from them? What are the measures that management has in place in terms of managing these risks? Those are some of the factors that one would need to understand when one is trying to do an understanding of the entity. And lastly, how is the entity measuring and reviewing its financial performance, right? So are there well-defined budgets? Are there well-defined key performance indicators? Um, are senior management compensation structures linked to profit measures, or is it more of a balanced scorecard? How does the financial performance of the company compare with that of its competitors? So these are the various factors that one would look at in terms of having an understanding of the entity. The understanding that is obtained by the auditor, besides helping us identify the risk of material misstatement, would also help in various other decisions and judgments that as an auditor one needs to make. So for example, determining the materiality of an entity for the purposes of financial statements audit, or identifying areas which may require special audit consideration. So for instance, an entity which is uh, you know in the space where there are lots of government policies and measures that are in play, one might want to focus on how various government grants are being accounted for. And that's just an example of an area that might require special consideration. And it helps us to develop expectations so that when we look at the financial statements, we can pick up the theme that is running through those financial statements and ensure appropriate analytical procedures. So at this stage, maybe we'll go into an example and then I'll come back to internal controls. So if everybody can read my slide, this is, an example where we've put out some financial data relating to a car manufacturer company. And the purpose of this data is for us to collectively identify some of the themes that we spoke about, right? So we spoke about doing analytical procedures, and we said comparing data of one period to another and picking up themes on the basis of our understanding of the industry and the environment and the entity, right? So if I can just take you through this. So this is a manufacturer of car, manufactures petrol and diesel cars. It has a headcount of 5,000 employees. The sales are mainly to US and Europe. There are manufacturing locations in India, China, and Europe. They have an R&D center where they do new product development. Okay, and their supply chain is largely from China. So if I look at this data on the basis of the conceptual understanding that we did, it tells us that it is in the auto industry, manufacturing petrol and diesel cars. We know that there is a sales concentration towards export. We know that there is a supply chain concentration because there is 50% of our supply that's coming from China. And we understand that it has 3 manufacturing facilities. Now, if I can add to this, and this is not on the slide, we also know from our understanding of the present external environmental factors. There's a big push by the government to move into EV vehicles. And so the company is exploring manufacture of EV vehicles. So with this, if we look at the financial data, there should be certain factors that should stand out for us, which could potentially lead into identification of significant risks, right? So if I start looking at the balance sheet, we can see that the property, plant and equipment between the last financial period to this financial period has increased. And given the push towards EVs, it's likely that some of the old models in petrol and diesel, particularly with the BS6 norms that have been introduced, may need to get phased out, which means that there could be a risk that the property, plant, and equipment may need to get impaired or may need accelerated depreciation for some of the property and plant which is being used in the manufacture of those models. If we again look at inventory, we can see that the inventory has increased. One of the things that we did note out of the observation and inspection procedure is, you know, this company is into a lot of bill and hold model, which means that the sales has increased, but the inventory has not moved out. So we saw a huge accumulation of physical inventory in the godown when we went in for observing the stock take, and that resulted in a risk that all the inventory may not be accounted. The other risk that we observed as a result of the inventory was linked to the understanding that we had, which is if the company, as a result of the BS6 norms, is looking to phase out the older models, there is inventory of spare parts and inventory of some of the old cars which was lying, which could mean that one would need to provide for that inventory. So that was the other risk that was identified as a result of the risk assessment procedures that we carried out. If I can then go on, if you look at borrowings, there are no borrowings. However, if you look at the statement of profit and loss, there is a finance cost of 135. Again, the question is, if there are no borrowings, then what is this finance cost relating to? Does this mean that there could be a misstatement as a result of an error that needs to get identified and audited? If you look at, again, on the profit and loss, the sales of products, our sales seems to have gone down from 37,000, it's come to 34,000. But our trade receivable seems to have increased slightly. So from 4,400, we are at 4,500. Does this mean that there is a risk that the sales that have happened are not getting collected and there could likely to be a sales return? Or we've pushed sales right towards the end of the year to meet our targets, resulting in a higher trade receivables. So these are some of the examples of the analytical procedures and identification of financial statement line items where one might want to look at a deep dive as a result of understanding the environment, understanding the entity, and understanding the operations of the entity. If I can come back to internal controls. So by now we've understood the environment, we've understood the entity and its business operations, its tone at the top. The next thing that as auditors we need to understand is controls, the controls that management have put in place to manage their risk. Again, the process of controls needs to be designed, implemented, and maintained by various levels. So in the first place, the responsibility is with those charged with governance, but on a day-to-day basis, this is actually applied by the management and other employees in order to ensure that the company's objectives are met without enhancing the risk or without creating any sort of, should I say, accidents arising out of these company objectives. Yeah. Uh, from an internal control perspective, one can divide the controls into entity level controls and process level controls. Entity level controls are those controls that operate at the highest level. So they essentially could mean controls that are at an entity wide level, for example, the whistleblower program or the customer complaint program that have been identified and set in place to directly detect any sort of failures that could possibly happen. There are indirect entity level controls that are also identified to prevent or detect the occurrence of risk. So, for example, the code of conduct. How have those charged with governance ensured that there is a well defined code of conduct, a well defined enterprise risk management program, and an appropriate internal audit to monitor the performance against the code of conduct and enterprise risk management program? Uh, the next level of controls would really be the process level controls. So again, these controls could be pervasive to the organization. So for example, does the entity have a well-defined um, delegation of authority structure? Are roles and responsibilities well defined? Is somebody doing both a maker and a checker role, whereby it may be possible to bypass these controls? So these could be pervasive controls, largely around roles and responsibilities, segregation of duties, and proper authority matrices. And then, of course, one talks about IT general controls. In today's world, most organizations have very well defined IT systems and IT environment. And how has the organization ensured that there are appropriate controls to kind of ensure the integrity of the data from processing of the transactions right up to recording of the transaction, and ensure that these are all effected in a manner such that there, the risk of material misstatement is reduced. Then there can be specific controls. So to a risk. So the controls are broadly divided into two types. It's preventive controls and detective controls. Preventive controls are controls which are put in place by management to ensure that a transaction can be maybe stopped before something goes wrong. Detective controls by its very nature are controls which are done, which take place after the transactions are over. So for example, an internal audit, or for example, a business review, or for example, you know, a, a specific review done for a particular transaction. These are all detective controls. The controls can also be fully automated controls, or they can be manual controls, or they can be partially dependent on IT dependencies. Um, Controls, as are designed by management, could operate daily or weekly. Some of the controls would be more monthly or quarterly in nature. These would essentially be more reconciliation and review controls. And then some of the other controls would be more annual in nature. So again, understanding what constitutes an internal control framework, right? What are the components of internal control that one should typically look at? And one essentially breaks that up into 5 parts. Control environment, risk assessment, control activities, information and communication controls, and monitoring activities. What does each one of them really mean? So control environment would typically mean what is the tone at the top, and we discussed this earlier. Is there a board and an audit committee. What is the composition of the board and audit committee? What sort of messaging is being done by that board and audit committee? Uh, how is the value system in terms of ensuring integrity and ethical values are complied with? So when there is zero tolerance for this, that sets the tone at the top, right? How engaged are the board or those charged with governance in business objectives, business strategy? How is business being delivered? What is the management philosophy and operating style? So is there a very aggressive management, or is there a more collaborative style that is followed by management? How is management's performance evaluated? Is it linked directly to business profits, or is it more of a balanced scorecard? Some of the things that give you an indication that the control environment is robust is, of course, a well-defined board operating effectively with a good and strong whistleblower policy, well-defined code of conduct, and well-defined organizational charts. The other component of internal control is risk assessment. So does the company have a well-defined process of assessing the risk? Is there a board committee which evaluates how the business risks are being assessed? Is it being is there a periodic review that is being done for the risks that has been assessed, and how likely are these risks to occur? Typically, a lot of large organizations have a very well-defined enterprise risk management program where risks at different levels and at different functions are identified and regularly reviewed, and performance is monitored against this risk. The third component is control activities. So, like I said, is there a well-defined delegation authority matrix? So, for instance, a payment up to an X amount can be signed by A and B, whereas anything exceeding the X amount will go to another level, and then exceeding the second threshold will go to a third level. So, what are the control activities, right? Uh, how are the authorization matrices set up? Is there proper segregation in those authorization matrices? Uh, how are the physical controls set up, right? So is the server on the premises? Is the server room left open? How easy is it for me to walk out of the office premises with assets that belong to the office, right? So these all constitute physical controls that would give you comfort on the internal control environment. We spoke about ITGCs. How is the information processing control set up? So is there a super user ID? Can somebody actually bypass all the processes and controls and pass an accounting entry to change the financial performance or financial reporting of the company? So these are things that give you comfort from a control activity perspective. Information and communication. So are the procedures, are the SOPs well defined from initiation of the transaction to recording and processing of the transaction and reporting the right transactions out? How are incorrect transactions or recordings dealt with? Uh, the controls that are put in place around these aspects is what constitutes information and communication controls. And lastly, the monitoring activities, right? So just as an example, are the bank reconciliations reviewed appropriately? Is there a business performance review that happens, whether on a monthly basis or a quarterly basis? At what threshold is it done? Is there a well-defined internal audit function? How often do the audit committee meetings happen? How is manager supervision carried out? These are the components of internal control that help you understand how to respond to the risk of material misstatement that has been identified earlier. So I think, again, like I said, this slide typically depicts risk of material misstatement. And like I said, you identify it either at a class of transaction or account balances or at a disclosure level. You could also identify it at financial statement level. So there could be a risk of material misstatement which may be pervasive to the entire financial statement, right? Um, you may have identified concerns about the integrity of the management as a result of the understanding of the entity that you carried out, or as a result of the information and processing controls that you looked at. You identified concerns around reliability of how the data is being recorded. So these could be various risks of material misstatements, either at an assertion level or a financial statement level. At an assertion level, an example could typically be, is the sales over recorded or under recorded? Is the sales recorded in the correct accounting period? So at an assertion level, we're talking about sales and cutoff and completeness as assertions over there. Identifying the risk of material misstatement is more about inherent risk. What's the nature of risk? How likely is it to occur? And if it occurs, how significant or how big can that risk be? Those are the factors that typically one looks at in terms of identifying the risk of material misstatement. Generally, one would not consider the control environment or the controls that management have put in place in identification of the inherent risk. Okay, so I did talk about identification of risks. And like I said, risk is a possibility that an event may occur, which will impact the organization and achievement of their objectives. We spoke about the COSO framework, which is the 5 components of the internal control framework. Ensuring that risks around compliance are appropriately identified. It can be compliance with applicable laws and regulations, and reporting. So preparation of financial and non-financial information, which is reliable and timely. So these are really the objectives. Like I said, risk identification is really on the basis of understanding of the entity and the environment, the process of finding, recognizing, and describing this risk. What could be the consequences of those risks? What are the enterprise level risks, right? So an organization which is which is only centric on profit could be could have a higher level of enterprise level risk, or an organization which is subject to high level of regulatory changes. For example, the financial services industry would be an organization which would be at a high level of enterprise level risk. And then, of course, the process level risk, right? What are the different business processes that an entity goes through, right from manufacturing of a product to sale of a product to the customer service that it provides? What are the different business processes? How do those business processes link up into financial reporting, both financial and non-financial information? And what are the process level risks that emerge out of those business processes that need to get identified and evaluated? So like I said, really the audit risk is a derivation from the business risk, right? It is typically a business risk that will give rise to an audit risk. So for instance, an entity which has, you know, only profit as it's achieving high level of profit as compared to its competition as a business risk, right? The audit risk coming out of there is whether sales is inflated, whether expenses are deflated. So audit risk is always a function of a business risk, right? And in carrying out the audits, the risk is that we issue an inappropriate opinion on financial statements that are materially misstated. The components of audit risk, like we discussed, the inherent risk in the business process. So identifying those, identifying the control risk. So whether the controls are, designed, the internal control system is designed to prevent and detect and correct a material misstatement, and the detection risk, that the auditor will not detect a material misstatement. So these are really, from the audit process, these are the different risks that we tend to deal with. Uh, how does one kind of deal with the inherent risk and control risk? By performing appropriate risk assessment procedures, understanding the entity and its environment in sufficient amount of detail, and understanding the internal control of the entity. The objective of the audit being to reduce the audit risk to an acceptably low level. So I will take a pause and see if there are any questions that we can address. Vinu, I'm not sure, is there a chat box in which participants put out their question?
Yes, ma'am. There is a chat box, but right now we don't have any particular question from the participants. Uh, Ma'am, one question. Like you had said, we need to inquire from the management about the particular business entity. So the inquiry should be in a written form, or verbal form will also be okay.
So it depends on what the inquiry is about. If it is routine, procedural, operational in nature, verbal inquiries are good as long as you document minutes of those inquiries. But if it tends to be more around certain misappropriations or more significant matters, then it is always advisable to do these inquiries in writing.
Thank you, ma'am.
Whether it is a verbal or a written, it is important that we document it in our file to demonstrate that as an auditor, I have asked all of these questions and this is how I've got the responses and this is my conclusion.
Okay. Thank you so much, ma'am. I think, ma'am, you have explained the entire topic so nicely that we don't have any particular questions right now.
Thank you. Thank you so much.
Okay, so I would like to thank you, ma'am, for explaining us the topic in such a detailed manner. And also, you had actually included within it the examples, like you included the automobile industry example. So we could correlate it and we could understand it very nicely. Thank you so much.
Thank you. Really appreciate the opportunity. Thank you very much.
Thank you, ma'am.
Shall we take a 5-minute break before we start the next session?
Yes, ma'am. Okay. Uh,
Sorry, Preeti, you're saying something. You're on mute.
No, ma'am. Just want to ask that next ma'am will going to come, no, for
I'm here only. I'm only talking.
okay. I cannot see your face, ma'am.
Okay.
So I need to introduce you, or you want 5 minutes break?
Yeah, let's take 5 minutes break if you don't mind. Or 2 minutes.
Okay, no
Which-
problem. Ma'am is not there. Someone is not there from the team. That's why I was waiting.
Can you see me now?
Yes, I can see you now, ma'am.
Okay. So what do you want to do? Can we take 2 minutes break?
No problem. We are hiding. 2 minutes. It's okay. No problem, ma'am.
Okay. Okay.
Only
Take
2
care,
minutes.
Preeti. Yeah, bye. Preeti, have I shared the screen?
Ma'am, your face is visible, ma'am.
No, no, my screen
No, your
is
screen is
shared.
not coming, ma'am. It's your no.
Is it coming now?
Yes, ma'am. Yes, ma'am. Now it's coming.
Okay, okay, okay.
Yeah.
Can we start now?
Yeah, ma'am.
So, thank you, Alpa.
Ma'am, can I give your introduction, please?
Yes, yes, please.
Yeah. 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 Today we have our learned speaker, Swapna ma'am. She has a 15 years of experience in his career, and he has an experience has professional work experience in several domestic and multinational clients have in his firm. And she includes retail and consumer sectors, industrial production and service industry. She also has an experience with risk and quality functions. She is passionate about quality management and is actively involved in quality management services excellence framework, implementing in audit functions and quality management review. She's an excellent speaker. I heard him before also, and I'm very glad to introduce her. And I want to thank you for on behalf of WYMEC committee and every person to accept our and ma'am to you.
Preeti, thank you very much for the introduction. Just confirm whether am I sharing my screen, because I think.
Yes, ma'am. Yes, ma'am. Your screen is visible, ma'am.
Okay, and also a big thank you to Alpa for setting the contest. Now that we have learned about how, I know we've gone through the environment and we have assessed the risk. Now it is this, so I'm going to take you all through SA330, which talks about auditor's response to the assessed risk. So what as an auditors, it's our responsibility to design and implement responses to risk of material misstatements identified and assessed in accordance with SA 315. So this standards gives us a guidance through which to obtain how much sufficient appropriate audit evidence that we need to obtain for the assessed risk to bring our material misstatements or a risk of audit risk to the low level. So again, this standard also has been introduced for all audits of financial statements for the periods beginning or on or after April 1st, 2008. So this standard defines substantive procedures and test of controls. So substantive procedures are those procedures which are designed to detect material misstatements at assertion level, which includes test of details and substantive analytical procedures. Test of details actually will happen over the class of transaction, account balances, and also in relation to the disclosure of FSLI in the financial statement. And test of control is to audit the procedures designed to evaluate the operating effectiveness of the controls in preventing, detecting, and correcting the material statements, misstatements at the assertion level. Now moving on, overall response as an auditor when we design and implement our audit procedure to address the risk of material misstatement, we need to consider a few factors. That is, as an engagement leader or as a senior person, we need to emphasize our audit team to maintain the professional skepticism throughout the audit, and we need to assign more experienced staff with special skills, and in some instances we might also have to involve experts to get subject matter expertise so that we can have a appropriate conclusion in the audit file. And throughout the audit, as a senior members and as an engagement leaders, it is our responsibility to supervise the staff so that there is no surprises at the end of the audit. And also it is important for us to have an unpredictability testing being introduced in the file every year. What is unpredictability? I think we need to understand unpredictability is that we do something different for the significant risk area, which the client might have not predicted that as an auditor they will do this. So unpredictability is a procedure that we need to do every year uniquely, not repeating the same procedures. And this is very important to have this unpredictability testing for the significant risk areas. Whatever as a significant risk, whatever areas you have identified as significant risk. Now, after identifying all of this, and the main thing is that when you do this understanding of the client and understanding of the business, then you'll have to come up with the nature, timing, and extent of audit procedures. Whether you need to perform substantive audit procedures at the year end, instead of that, whether you want to do it at the interim period. And what happens sometimes is that when you do an audit procedures at the interim level, it helps us to understand the misstatements, if any, which we can take care of that in the year-end audits. Now, what happens is when you've done all of these, as per SA 315, you've understood the entity and you've gone through and you have now got into a controls and you've identified all of these controls within the organization based on the control activities. Sometimes what happens that not all of these controls are operating effectively, right? When you have identified some of the controls are not working, or maybe there are instances where because of the IT general controls, if there is no comfort from the IT general control testing, then there are chances that we can say that some of the controls are not working effectively, and we might say that there are deficiencies in internal control. So that time, maybe we'll have to look back, take a step back and see what are the procedures we need to carry out to get comfort on our material misstatement, whatever we have assessed as a risk. Now, what happens is when your controls are not working, so it is more as an auditor, it is again a judgment that whether you really want to go ahead and do an interim audit, because then it is more appropriate to perform more audit procedure as of the period end. Then when there are no controls comfort, then it is more obtaining more extensive audit evidence from the substantive procedures will have more impact on the final results of the audit outcome. Now, again, when there are no controls in place, maybe you might increase the number of locations or number of samples to get more comfort on the audit scope. Now, when we talk on these deficiencies in internal control, so the control might be that there is a cyclical physical count, cyclical physical count happening by the management. But sometimes what if we come across that whatever the cycle count has happened is not working effectively, then definitely for us as an year-end process, we'll have to do a physical verification with the management. So that is where then it becomes more of a period end process where we get more extensive So then again, the number of location where we go and do physical count will become important for us to have a more coverage from audit perspective. So as I mentioned, when there is no ITGC comfort, we can see what happens is that we get more reliance from the automated controls, right? When there is no ITGC comfort, we won't be able to rely on automated controls. And what we'll do at that time, that if there are no automated, I mean, if we cannot rely on the automated controls, then we'll have to find and ask the management to come up with, show us the manual control, which compensate the automated control to address the risk at the same precision level. If there are no manual controls, then we will have to again depend on the substantive audit procedure. See, now you all know that we have an IFC opinion to issue, and considering that we need to issue an IFC opinion, then as an auditor, it is very critical for us to ensure that there are controls in place. And if there are no controls in place, of course, if you don't get sufficient appropriate audit evidence, then there will be an impact on our audit opinion. But before that, as an auditor, you will have to see all the options to see that are there any mitigating manual controls, so that we can test those controls and get that assertion addressed through manual controls, and then see what is the final outcome of our testing results, and based on that we can issue an opinion. Now, in most of the cases, the most appropriate approach is to have combined approach, wherein you will have comfort on some of the assertions through controls testing, and when the volumes are high, in terms when you have sales volume is so high, and if there is an ITGC comfort, ITGC as in IT general controls are in place, and if we have comfort from completeness perspective, when you have a comfort, it becomes very efficient and effective to rely on the controls to get completeness assertion comfort. Whereas when it comes to cutoff, like as Alpa mentioned, it is prone to be error, right? There are so in those cases, we can do a substantive audit approach. So it is advisable to have a combined approach where you have ITGC comfort and we can demonstrate that the controls are operating effectively. In such cases, we can have a combined approach. Now, moving on. Okay, now as again, see all the procedures, whatever you plan in audit, it mostly circle back to your SA315, where you've understood the environment of the company and you have done an understanding and evaluation of the controls. Basis that, then we can, those are the factors which will influence us as auditors to perform audit procedures. Like Alpa has mentioned, the control environment, when relevant information is available. So for example, when you're doing an ITGC testing, when you have to do an ITGC testing, you can't go and test the ITGC control, IT general controls after the year end, because as an auditor, we need to get comfort that the ITGC controls were operating throughout the year. So it is for us becomes very important at what point of time that we go and then test all of these controls to get comfort on the ITGC. Now moving on, the nature of risk. Now the risks are broadly divided into three main categories: normal risk, significant risk, and elevated risk. Now, as part of your understanding of the business, once you have identified what is my significant risk and what is my normal risk and what is my elevated risk because of the events which have occurred during the year, some of the items or some of the FSLI generally used to be in normal risk, but because of 1, 2, 3 events which have happened in the current year, which you have decided as an engagement team that this will be an elevated risk. So you will come up to the risk assessment. Now, once you divide this normal risk, significant risk, and elevated risk, that is where the crucial part starts as an auditor, that what should be our audit responses to these risks and how am I mitigating my audit risk to come to a conclusion and issue an opinion. And period or date to which the audit evidence relates. Now again, which year, as I mentioned, ITGC, if you are doing it, you need to do it during the year and ensure that the controls were operated throughout the year. So it can't happen you go after March and say that I go and test, because what happens is some of the electronic trails and all get changed after the year. So that will not give you a robust evidence to prove that the IT general controls were operating effectively. So it is very important that we select a period or a date, and then we have to ensure that the audit evidence relates to period for which we are opining on. So all said and done, so much we spoke about ITGC and all of that, but not all companies have this kind of setup. There are some smaller entities. There might not be a many controls activities. And also maybe the documentation, the way the management has put across their controls or activities or process are very limited. So in that case, as an auditor, for us, we'll mostly, lean towards substantive procedures only. But if you have an IFC applicable, then definitely when we say IFC is applicable, it will not be a very smaller entity. But smaller entities are though assuming that it is all, there is no IFC opinion. In those cases, we will extensively do substantive procedures to mitigate our audit risk. Now moving on, let's little more detailedly, we will see what is that we will cover in test of controls. Right? What do we do in test of controls? That there is a design and there is a process and there is a control activities. And now the management is saying that within this process, there are, let's divide the process into sales, purchases, revenue receivables, purchase payable, treasury, property, plant and equipment, and we will see what are the significant business process for them. Now, out of that significant business processes, out of the business process for us, some of the FSLIs may be significant. So as part of our understanding, we did an understanding, but we will have to evaluate. We'll have to do a design assessment. So how do we do design assessment? So we do from cradle to grave, as in when you raise a purchase from the customer master creation till you realize your sale value. There are processes which have been drafted by the management saying that this is my process, these are my sub process, under the sub process these are my control activities, and for those control activities these are the controls. And then what when we do as part of the design assessment, you will have to sit with the client, take samples, one sample, and across all the key controls, you have to ensure that whether it is being operating effectively. Now that I'm telling for design assessment, okay? When you do design assessment, it will be one sample across all the controls to ensure that it has been operating, it has been designed effectively. Now, the sample size, what you take for design assessment and the sample size, what you take for operating effectiveness of those controls will be different depending upon the frequency of the controls. Like how, if you all remember what Alpa said, that the controls are divided into two. One is detective control, another one is preventive control. All these preventive controls are mostly linked to automated controls, where the controls are in place within the system that if there are any mistake or an error occurs, and it will be taken care. But if there are no, then the other part is detective control. Those are all manual controls that will be in terms of reconciling, somebody reviewing it, after a month closure, or reviewing the FSLI schedules, reconciliation, trade payable, trade receivable, aging, looking at the aging, all of this. Now, what we have to see, one is that as an auditor, we expect the controls are, we have to check whether the controls are operating effectively or not. So once after doing a design assessment, if we are intending to rely on the controls and then we've concluded that yes, the control is designed appropriately and we have an evidence to test, then we'll go ahead and do operating effectiveness of control. So then there it is an important thing to identify nature, timing and extent of. So depending on the controls what we rely, basically then we will go ahead and do our substantive procedures testing plan. But as all said and done, substantive procedures alone cannot provide sufficient appropriate audit evidence, especially when it is a large setup. It is very important that we get, I mean, it is important for us to get an ITGC comfort and then have a controls basis audit, so that you have relied on the controls, and especially automated controls being preventive in nature, it gives more comfort than only relying on the manual controls. So sometimes there are two things, as I mentioned, TOC as a test of controls, different from understanding and evaluating design and implementation of controls. But same type of audit procedure will be used for your design assessment and also for operating effectiveness, but only the difference will be the extent of testing, how much you will test in for operating effectiveness and design assessment. And in designing and performing test of controls, obtaining more pervasive audit evidence to be able to place greater reliance on effective control. So it is the more the control reliance and the more the pervasive audit evidence, more comfort we as an auditor to evaluate the FSLI number and then move on to the opinion. So as I mentioned, the extent of test of controls, the factors to be considered is frequency of the performance of the control by entity, whether it is weekly, monthly, if it is sales, purchases, definitely that will be at a transaction level, it will be as and when. But there are some controls like review controls or reconciliation control that will be monthly, and there are some controls which will occur on an annual basis. So basis that, the sample size for control testing will be decided. I think SA 530 talks about audit sampling. We can refer to that while doing the audit sampling. Now, again, while doing an extent of test of control, now reliance and reliability of audit evidence at assertion level. For example, if some of the assertions are addressing significant risk, then our sample size may be a little higher to get more comfort. Now, timing of test of controls. So as I mentioned, the timing will be, for some of the controls, it will be at a point of time, and some of the controls, it will be over a period of time. Again, it depends on the effective and efficiency of the controls after we perform. Especially these period and financial reporting activities, which will happen on an annual basis, wherein if there are any impairment, if there are any impairment, and if there are any that the management might be doing at an annual basis. So for that, it is very important to understand from management what frequency or what intervals that the management is doing all of this activity. So what is assertions? Representations or details provided by management on classes of transactions or balances. So that based on that only we'll be able to fix our control testing or substantive audit procedure. Another thing what happens is that now we are in this year. We've also performed the audit of the previous year. Now, as an auditor, we'll have to see that were there any deficiency in the controls identified in the prior year. And then we as an auditor, how can we address those deficiencies, I mean, what is that management has done to address those deficiencies, and what is the current year status of the deficiencies. We'll have to discuss with the client and see that where are they in terms of those deficiencies. And if it has been said that it is done and then it is all operating effectively, definitely this year again you all have to do an understanding. As an auditor, we all have to do an understanding and understanding again of the whole process and do an evaluation of that, and then go ahead with the testing. But if there were no deficiency and everything was fine, we did understand that the controls were operating effectively, and there are no change in the management, or there is no change in the person who is involved in this control, and there is no change in the process document, then we as an auditor can have at least once in every third year being, doing a control testing. But this is not applicable for the significant risk areas. For all significant risk areas, we need to ensure that we do understanding and evaluation of the control at least annually. Okay. And then as as an auditors, one is that being professionally skepticism throughout the audit, planning, execution, completion. And also as an auditor, it is through our professional judgment, we need to we need to make a decision that how much is that on how much is that I'll do perform controls, whether should I go ahead and do control testing for the current year, or whether can I rely on the previous year control. All said and done, it is that once in a 3 years test of controls, but I think understanding and evaluation and design assessment is required for every year. See what happens in controls. Again, there are different procedure we follow, right? Inquiry, observation, inspection, and re-performance. When there are no, as I mentioned, first step is to do understanding and evaluation. That will be through inquiry. After doing inquiry, if you come across that there are no changes from the previous year one, then maybe you can take a call if being, depending on whether it is a significant risk area or a not significant risk area. Then if we decide that no, but we will go ahead and do testing, then for some of the controls, we'll observe the controls and also do an inspection of those controls or audit evidence, and also do re-performance of something to check that whether the rigor in which the management has monitored the control, or rigor in which the management has assessed the output of those controls are rigor, whether it is appropriate or not. It is important for us to re-perform whole procedures to understand the rigor of the overall monitoring activities being carried out by the management. Okay, now what does that mean? Now here what we are saying is that what does that mean? Non-detection of misstatements in the control testing is not an evidence that relevant controls are effective. Okay, sometimes what happens is that you all have done the control testing and controls were operating effectively. You didn't come across any exceptions, right? But when you move on to substantive procedures, you have identified that there are material misstatement which will have an impact on your audit opinion. So quite obviously, we will think that we have done a control testing and then there are no discrepancies or an exception noted. However, when you come back to substantive procedure, you've identified some material misstatements which will have impact on our opinion. So the ISA is very clear that if no detection of misstatement in the relevant controls does not mean that the controls were operating effectively. When if you get any material misstatement identified in your substantive procedures, you'll have to go back to your control testing again and see what has gone wrong. See if there is a material misstatement, that means that there was a deficiency in the controls and the way it was operated. Hence, accordingly, it will have an impact on our IFC opinion as well. Okay, so there will be deviation from the controls, but we have to make specific inquiries to understand in the matters and potential consequences. And then we'll see, are there any additional testing required for us to conclude on our TOC testing, that is test of controls. And then for some reason, yes, controls, for whatever samples we've tested, controls were working effectively, but we've got exceptions in the substantive procedures, then accordingly, then it'll have an impact on our audit IFC opinion as well. Now that we have done control testing, it is the substantive procedures. I think we do have, our audit opinion mostly, other than IFC, if it is the main audit report, is mostly depending on substantive procedure. If it is a smaller entity, definitely there will not be many controls or limited control activities to comment on. So most of us generally be depending on the substantive procedures. So it is very important for us to decide our substantive procedures basis the risk what we have assessed, whether it is a significant risk, whether it is a normal risk, and whether it is an elevated risk. It depends on the way the engagement team has concluded their risk assessment, and they plotted each FSLI, what are the risks that they're carrying on all of those FSLIs, and then coming back to controls, how much comfort I'm getting, on which assertion I'm getting control comfort, and then what are the rest of the assertions on which I need to do a substantive audit procedures. Now we all know that we do for purchase, sales, bank confirmations we send, for all account balances, basically trade payable, trade receivables, we try and get confirmation, third party confirmations. But apart from this, especially there are two risks which we all have it in our financial, is that one is on the risk of fraud on revenue recognition. Another one is management override of controls. When we talk about management override of controls, the main things will be journal entries and related party transaction, accounting estimates, and accounting estimates again involves impairment of PPE or impairment of goodwill. So these are some of the areas I think we need to be very clear in terms of fixing our substantive audit procedure. Now, when it is a confirmation procedures, we all know that we directly send confirmation to the bank and get confirmation, and also trade receivable, trade payables, and also some of the legal matters also, I think. Some of the legal matters also, I think it is important for us to get direct confirmation from the external legal counsel, and also use of experts. See, some of the valuations, now if it is a impairment assessment for a CGU or an impairment assessment for investment, management would have used a model in which there will be assumptions used, WACC rate, discount rate, and cash flow projections. So it is important for us to identify specialists who can help us in evaluating those management assumptions. And also we as a main audit team, is important for us to evaluate the projection used by the management, sitting with them and understanding not only from qualitative perspective, it is important for us to understand from quantitative perspective also, and then document the rationale behind all of those projections, and then you get convinced that the projection made by the management is appropriate. So that is for all management override of control. So now, and for us, we also have to go through the board minutes. Board minutes is an important document wherein there will be a lot of management decisions. What has happened during the year? What decision did directors took? All of that will be documented. So as an auditor, it is important for us to go through the board minutes and then see are there any matters which will have an impact on the audit, and then please document everything. You must be doing a lot of things. It is important for us to put in our planning stage itself that we have gone through the board minutes, these are the matters discussed and this is the audit impact, and then you link it to your work done where you have addressed all of this audited impacted matters. That is one thing. And then what else? Substantive procedures. Then we have an analytical procedure. Analytical procedures are used more in case of large volume of data that tend to be predictable. Like for example, rent. You can say that there is an agreement, there are 10 rents, there's a rent agreement, and each agreement is for a specific period with a specific escalation clauses every year. So you can predict whatever you can predict, and also whatever you predict basis the external data available, you can do um, substantive analytical procedure for those FSLIs. And coming back to now closing process as a financial statement, okay, I have now validated purchase all P&L items. We have validated all balance sheet items. Now we are at the closing process. So it is important for us to do a journal entry testing. Please do journal entry testing at the beginning of the audit. Generally, people tend to do all of this because it is one of the process which will address management override of control. So it is important for us to do an journal entry testing. Again, define criteria. We can't do 100% of all the journal entries. So we'll have to define criterias. Unusual entries. What are unusual entries? Again, here it is depending on the discussion what we all have with the management. We will identify what is usual journal entries and what are unusual journal entries. And then for those unusual journal entries, you'll have to make a bucketing and then arrive at a sampling process and then go ahead and perform testing to ensure that there are no risk of material mismanagement in those journal entries. Now, after that, then it is about agreeing, reconciling financial statements. So you'll have a TB, you ensure that the TB is what is the number which you've audited, and then that when you have to link it back to your final financial number. So again, it is very important that we do all of these things and then link back our responses to the significant risk or whatever risk we have identified for those FSLIs. So you'll have to ensure that I had this risk and this was my control comfort and this is my substantive procedure that I've done, and now this is the final outcome of it, and that is what is going in the financial statement. All these link should come out in our documentation. So why am I emphasizing more is that whatever you do, if you don't put it in your documentation, what it is not done, what is documented is what done. So it is very important for us to demonstrate that from start to end, what is that we have done. So now once we have concluded, we have come to this level, now put all things together and see that whether we have got enough appropriate and sufficient audit evidence to conclude on the audit. As I mentioned, don't assume that it is an fraud or an error is an isolated occurrence. You will have to, one is that you be aware, and also please ensure that your team members are also professionally skeptical throughout the audit. It is more important. I feel vouching is the area where you can get to know a lot of things. So it is important that we been there with them and supervise them and then ensure that all the matters at a ground level has been escalated and not been, taken lightly. So another thing is that we have to consider all relevant audit evidence, regardless whether it appears to be corroborate or contradictory. And for any of the assertions in the financial statements. So once we bring all of this together, I'll go back to the next slide and come back to this slide. Now, again, as I mentioned, it is an important thing is to document. Document your professional judgment, document what are the nature, timing, extent, and audit procedures you've followed. What is from where are you have to link from the starting, from understanding. We did an understanding of this process. These are the controls. This is what we have done. And this is my substantive procedures, and this is the outcome. And some of the cases, if you didn't have ITGC comfort, please ensure that you do a report testing. Most of the clients, except for very small entities, most of the clients use ERPs in some or other form. So all of the reports will be coming out from the system. So when we say that ITGC, IT general controls are not working. So, I mean, I'll just tell you why there might, some of the instances where you don't get comfort is because there might be SOD issues, segregation of duties issues, or whenever some people might have super user access, and when you're giving an access to somebody, there is no proper approval mechanism as followed, or if there is a change in the personnel who is performing ABC activity, that time there was no appropriate approvals have been taken. So these are all some of the examples through which you wouldn't have got ITGC comfort. But what happens most of the times, we do take out reports now, sales term, purchase term, fixed asset register, maybe inventory register, everything comes out from the system. So now when you don't have an ITGC comfort, and we as an auditor, we cannot just rely completely on these reports. You'll have to perform testing. So it is important for us to document this. Yes, there was no ITGC comfort, but we have used 1, 2, 3, 4 reports. But on this report, before I do a substantive procedure or a control testing, I have done 1, 2, 3, 4 to ensure that the outcome of the report from the system is complete and accurate. That is one that we do. Second thing is that we also have to document what is that management has done to ensure that in spite of not having ITGC comfort, how is management comfortable using all of these reports for their monitoring activities. So all of this question is, as an auditor, we should ask the client and bring our response together and link all this process from the beginning till the end to arrive at a conclusion. So now how much you want to document, what is that you want to document, for which area, how much is the requirement is a professional judgment. But as I mentioned, for significant risk areas, if you call revenue as a significant risk area, then for that you should ensure that you bring and document as much as possible to demonstrate that this is my risk assessment and this is my response, basis which this is my final conclusion. Now, once you all have done, I'll go back to the previous slide. Now, once you all have done all of this, now it is my final deliverable time. If you've got everything good, everything is fine, then there will be a clean opinion. But if you've not got sufficient appropriate audit evidence, then it will be a qualified or a disclaimer or an emphasis of matter. All of this then again will go back to SA 705, 706, and what are the wordings to be used and how we need to ensure that this comes in a documentation file that we will use SA 705, 706 and then conclude our audit. That is all from my end. If I have any questions, then I am happy to take it.
I request participants to please write your question in question answer tab.
Preeti or Poonam?
Yes, ma'am.
Are there any questions?
Ma'am, I'm not able to see any questions. I'm requesting participants to please put your question answer. Yep.
So then we'll wait for 2 minutes. If not, then
Yes,
we can conclude the session.
yes, ma'am.
Poonam, then if you have no questions, then I think we are good to go. Thank you very much for calling us and inviting us for this wonderful presentation.
Ma'am, there is no question from the participants, but I want to ask about the test of controls. Ma'am, can you elaborate what like test of controls, what the precautions we should take during the
As in,
testing of controls?
I mean, sorry, I am not getting your question. What precaution, as in, what is your question? What do you need to do in test of controls?
Testing of controls. What is the effective way?
See, you will have a risk and control matrix defined by the management. And for example, if it is a sales, right? And for sales, I'm just taking an example so that I can explain you better. And then as per the sub process, they will say that all the prices, if there is any change in the price for some particular product during the year, this needs to be approved by ABC. Okay, that is the control. And without any approval being done for those change in the sales price, then those will not be uploaded in the system, or those selling prices will not be used for selling the product. So if that is a control which the management has defined, now you will have to do testing. What one sample as a walkthrough you will do to understand the design. You will select a sample, you will select an invoice, and you will see that whether it is as per the approved price list. But if it is not matching with the approved price list, then you will ask, what is the reason for not being, same with the approved prices? Then they'll say, no, there was an approval, and which has been, this is a control. If there is a deviation from the master price, there will be approval taken from ABC, right? So you will go ahead and then ask for them to show, okay, was a deviation, then show me who has, whether this ABC person has approved it. So that one samples you will do for a design assessment. Now so you'll ensure that, from that walkthrough, that the design of the control is appropriate, wherein you could get the evidence for one particular sample. Now you'll have to do an operating effectiveness testing, right? Operating effectiveness testing is for the throughout the year, not on one sample. So you will have, for example, more than 250 samples during the year, sales made. Okay, so for that you will have to ask from management that how many of these sales are with the deviation approval, right? But again, that will be a sample which they give. So, but what you will do is, from the 250 sales made during the year, you will take samples. Now, sampling you can refer to SA 530. There it is prescribed some number of samples. For example, if it is a daily occurrence, if it is more than 250, assuming that you'll have to do some 20-25 samples, you will select 25 samples throughout the year, April to December. You will select sales as samples. And for those 25 samples, you will see that the price as per the invoices versus whatever is there as per the master listing, whether it is matching or not. And in some of the cases, if it is not matching, whether the controls were operating effectively with the control narration, what you have written there, control description saying that if it is not matching, that ABC has to approve, whether that ABC approval has been obtained or not. That ABC approval can be through mail, or can be through, it can be through mail, or it can be one approval wherein he would have said that for this deviation from this period to this period, I agree, I approve. So this is what we have to test when we talk about control testing. Operating effectiveness, you need to test throughout the year. You have to take samples throughout the year.
Okay, so like from only one quarter or from only 1 month, we should not take sample throughout the year. If we are taking, then only the effective.
If you're doing an interim testing, if you're doing interim testing for a quarterly basis, then the samples will be restricted to those particular quarter. But if when you're opining on IFC, it will be for the year. So your sample has to be throughout the year. So it will be from April to March. The samples of 25 should be across all months.
Understood, ma'am.
Okay.
Thank you so much, ma'am. Understood.
Thank you.
So, ma'am, once I'm checking here, so there is no query from the participant. So on behalf of Women Excellence Committee, please accept my formal vote of thanks, and thank you so much, ma'am, for such a wonderful presentation with such a clarity. Thank you so much, ma'am.
Thank you. Thank you all.
Thank you, ma'am.
Thank you. Bye-bye.
Bye.